Hello viewers, we'll be going over the Dow Jones ETF ticker symbol DJIA. In this video, we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, comparing the current trend with the trend in the past, and we'll go over the day-by-day forecast for the Dow Jones. So back to the technical analysis. On Friday, we closed around 1.4% on the 1-hour chart. We have now approached to positive MACD and we are near overbought RSI. As for the 4-hour chart, right now we see a convergence. We're still in a negative MACD and we have not quite reached to overbought RSI. And on to the daily chart, what we have here is we see a convergence still on positive MACD, and we are also seeing a convergence on the 9-day moving average converging onto the 18-day moving average, the blue and purple line respectively. And at the moment we may see temporary higher lows, so that is a positive sign that we may continue this uptrend. If we do continue to head up higher, the next possible resistance will be around a price of, say, $267 if we do manage to break above the 200-day moving average, this green line. And as for support, we did find support back in, say, June 29th, the 50-day moving average, this yellow line, acting as our previous support. And the next support will be around $253.68. So if we do manage to fall back to that support level, that price movement to the downside is roughly around 2.7%, and to the upside, that price movement is roughly around 2.4% to the upside. So now let's examine the day-by-day probability model. And these models are available in the link below, so do check it out. As we progress to the 7th day, we have a 40% chance for Dow Jones to climb higher between 0 to 1.5%. And on the extreme case, we have a 10% chance for Dow Jones to climb between 1.4% to 3%. And to the downside, we have a 30% chance for it to fall between 0 to 1.5%. And further extreme case to the downside, 20% chance for it to fall between negative 1.5% to negative 3%. So now let's examine the day-by-day forecast for the Dow Jones. And we have 1 day out, that will be a Monday, and 2 days out will be a Tuesday, and so on. So we have 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend. Right here we have our current trend as our blue line, and overlapping it happens to be the best match. And right here we have our current trend, and below is a trend that we found on the line graph above, and this trend dates back to April 21st, 2003 to July 16, 2003. So let's begin comparing both of the trends. So on the current trend, we saw averaging above the middle Bollinger Band, reverse to head down to touch the bottom band. Once more, we touch the average above the middle Bollinger Band, and then once more again, touch the or near the bottom band, and then towards the very end, we revert back to the mean to the middle Bollinger Band. And now in the trend in question, we average above the middle Bollinger Band, and then we proceeded to dip lower below the middle Bollinger Band, and then once more we average above the middle band, and then finally we touch the bottom band once more, and then towards the very end we revert back to the middle band. So what we have here is 1, 2, 3, 4, 5 points, and we also have 1, 2, 3, 4, 5 points on the current trend. So there's reason to believe that the trends and patterns are somewhat the same. The outcome and forecast should be fairly same. So the model that we just examined was back in April 21st to July 16, 2003. Back then, Dow Jones continued to climb higher between, I would say back then it climbed 1.7%. And if we head back to the day-by-day probability model, that coincides with this standard deviation on the extreme case, 10% chance between 1.4% to 3%. And let's examine closer on the technical performance of each trend. And if we examine on the current trend, we're down 6% from monthly high, up 12% from monthly low, up 1% from 10 simple moving average, up 80 basis points from 20 days simple moving average, and up 3% from 50 days simple moving average. So now let's compare that to the trend that we just found. Back then it was down 2% from monthly high, up 9% from monthly low, down 32 basis points from 10 simple moving average, down 4 basis points from 20 days simple moving average, and up 2% from 50 days simple moving average. So there are technical differences among the two trends. One is in the 10 simple moving average down 32 basis points. Compare that to the current trend, which is up 1%, and the 20-day simple moving average down 4 basis points. Compare that to the current trend, which is up 80 basis points. So do keep that in consideration, and these models are available in the link below. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.